Recently, I've been talking a lot about how the real estate market right now is so tough for home buyers. Low inventory, prices are increasing, interest rates are now increasing. And so it just left me wondering, how can I help potential home buyers like you look at different ways to make housing more affordable? Well, one way is to look at different property types. And so today I wanted to share with you the differences in monthly payments and potentially down payments between single family homes and attached properties like condos and townhomes. You start to see some of the major differences, which might just be the difference between you purchasing now or having to wait. And at risk of sounding like an infomercial, wait, there's more. You want to buy your first home, but maybe you don't have 20% to put down or perfect credit. That's okay. If you're committed to a home purchase, then I'm here to help you do just that, maybe even sooner than you thought possible. My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Eagan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button, and together, we'll make it happen. The point of this video is not to talk about the differences between detached properties and attached properties. Instead, today, I'm talking about the difference in down payment and monthly payments on detached properties versus attached properties. So let's take a look at what a detached or a single family residence would look like if you were to finance it in the Denver metro area right now. In my recent market update, I explained that the median home price according to the Denver Metro Association of Realtors is $475,000. However, that's a mix between detached properties and attached properties. So if we look at just detached or just single family homes, what we see is that the median home price is sitting at $530,000. So the first thing that we might want to look at then is going to be down payment. Well, generally for a conventional type loan, the minimum down payment is 5%. Sure, there are some exceptions that can get you down to as little as 3% or even less with down payment assistance, but for the purpose of today's video and comparing between single family or detached properties and attached properties, we'll assume a 5% down payment. So $530,000 times a 5% down payment is $26,500. To get to the loan amount, we simply subtract the down payment from the purchase price, and we end up with a loan amount of $503,500. From there, we'll look at average interest rates. The weekly rate survey shows that the nationwide average for interest rates is currently sitting at 3.17%. So if we take that $503,500 loan amount that we calculated at a 3.17% interest rate, we can calculate a principal and interest payment, which ends up at $2,169.22. In addition to the mortgage payment, the principal and interest portion of your payment, there are also taxes and insurance. So property taxes vary depending upon the property that you're ending up purchasing, the area of town, all of those sorts of things. But if we look at just general averages in the Denver metro area for a $530,000 value home, we're looking at property taxes at roughly $3,600 each year, or $300 a month. Property insurance also varies significantly from situation to situation, depending upon your credit score, the age of the home, different quality characteristics of the home, things like that. But again, we'll just use some general averages here for calculations. So I've used $2,160 in an annual homeowner's insurance premium, which is basically $180 a month. The other thing we need to account for is mortgage insurance. When you have a down payment of less than 20% down, mortgage insurance will be required. Your mortgage insurance will vary based off of your down payment and your credit score. Well, we've already said that we're assuming a 5% down payment, so the next variable is credit score. Well, there's no way, of course, for me to know what your credit score is, so I've just used a general higher end credit score. Well, that comes out to about 0.5% each year, and if we calculate that out on a monthly basis, what that means is that the monthly mortgage insurance cost is $210 each month. So let's add all of this up. We've got a principal and interest payment of $2,169.22. We've got property taxes of $300 a month. We've got homeowners insurance of $180 a month and mortgage insurance at $210 a month for a total monthly payment of $2,859.22. Now this is the point in the video where a lot of YouTubers will ask you to like their video. Well, I'm not going to ask you to do that. Instead, I'd like you to continue to watch. If at any point during the video you've learned something or you've gained some valuable insight that's going to help you in your process of buying a home, only then please like the video. So now let's look at what an attached property might look like, either a townhome or a condo. The median home price in Denver Metro in February of 2021 was $337,250. So once again, we'll assume a 5% down payment. If we calculate that out, it comes to $16,863 down. That means we have a loan amount of $320,387. Using the same average interest rate nationwide of 3.17%, using that loan amount of $320,387, we end up with a principal and interest payment of $1,380.32. Property taxes will use the same rate that we used for a detached property. However, because the property value is lower, so are the property taxes. So that comes out to about $2,400 a year or $200 a month. Property insurance is a different story. And the reason for that is because there is a homeowners association generally included when purchasing an attached property. Well, part of your homeowners association dues includes property insurance to cover the exterior of the building. So all you have to cover is the interior or the contents of the home. So that means, of course, your property insurance will be far less than it is on a detached property. Again, it'll vary based on lots of different situations, credit score, things like that. But if we just use general estimates, we're looking at about $900 per year to cover the interior or the contents of the home. That means $75 a month. And then, of course, we've got to account for that HOA. So I'm going to use $300 a month, which seems to be about the average in that particular price range. And just like with the detached property, we also have to account for mortgage insurance. And again, because the purchase price is lower, therefore your loan amount is lower, and therefore also the cost of mortgage insurance. Now, it's still at the same rate that I'm using, 0.5%, but what that does is it comes out to an annual premium of $1,601.94 or $133.50 each month. If we add all this together, we've got a principal and interest payment of $1,380.32, property taxes of $200 a month, homeowners insurance of $75 a month, an HOA of $300 a month, mortgage insurance of $133.50 for a total payment of $2,088.82. So you can already start to see some of the major differences between purchasing a detached home and an attached home. First of all, prices are significantly lower on attached properties. But that for you, in terms of mortgage financing, means a lower down payment, even at the same percentage down payment. So with a 5% down payment on a detached versus an attached property, you're talking $9,637 less in down payment on an attached property versus a detached property, which might just be the difference between you purchasing now or having to wait. The other thing is a lower monthly payment. Because you're purchasing at a lower price point, you also are going to incur a lower monthly payment. In fact, it comes out to $770.40 lower in a monthly payment on an attached property versus a detached property. And at risk of sounding like an infomercial, wait, there's more.
Now that's a deal.
It may not sound like a big difference, but currently detached properties are only spending 4 days on the market. Attached properties are 50% longer at 6 days on the market. And again, it may not sound like a lot, but what that means is there just isn't as much demand for an attached property, which means you might be able to have a little bit better shot at getting your offer accepted if you're looking at an attached property versus a detached property. And we're seeing that in the close to list ratio. For detached properties, what we're seeing is that the close price is 102.49% of the list price, which means that buyers are paying 2.49% higher in price for a detached property. On attached properties, it's sitting at 100.79%, which again means that buyers aren't having to compete or overbid as much on attached properties in comparison to detached homes. And there's one last thing, and I can see this as both a positive and a negative. See, what it is how much has the home price increased over the last year? Well, on detached homes, we've seen a price increase of 21.84% over the last year in terms of median home prices. Attached properties have only seen a 12.79% increase. Now, both of those numbers are a significant price increase over the last year. However, what we can see is with attached properties, it's significantly less, which means that attached properties have just been more affordable in comparison to detached properties. But here's the flip side. See, owning an attached property means that you may not see as much price appreciation as you would if you owned a detached home, especially if we look over the last year. So which one is right for you? Detached or an attached property? Well, ultimately that is a personal decision depending upon a lot of different factors. But what I can say is that buying an attached property might just be the difference between buying now or having to wait until the market softens up a little bit and turns more into a buyer's market rather than a serious seller's market. So there's the information you need in order to make an informed choice as to which one is right for you.